All attendees are in listen-only mode.
Well, here we are for the October edition of the BizNews Global Share Portfolio. And in Afrikaans, there's a wonderful little song that says, Oktober is die mooiste maand, which means the most beautiful month in the year. And as far as our portfolio is concerned, this has really been the case. The performance of the portfolio has been quite astonishing. There we go. You can see it starts off a little yellow, but there we're having a look. It's been amazing. We are, remember, investing for the long term, but this past week has been an extraordinary one for tech stocks. And because we go for exponential companies in this portfolio, the tech stocks on the US have performed well. We had the double whammy effect because this portfolio, you might recall, has been structured to give us exposure against the rand. So in other words, our main view is that the South African economy is being poorly managed, and as a consequence of that, the currency for the economy, or the share price of South Africa Inc., which is the South African rand, will come under pressure, and our advice has always been to protect yourself against this. Now, in the last 3 years, it's been a good strategy, but in the last month, it's been brilliant. As the Finance Minister Malusi Gigaba's credibility gets undermined more and more, which is not surprising because this is a fellow who, you might recall, was one of the first to get involved with Brett Kebble, the crook mining magnate who organized for himself to be bumped off, assisted suicide as they called it at the time. Malusi Gigaba's track record in various government departments has been anything but exemplary. And now he's the finance minister. So the markets have pronounced very cynically on his mini budget speech and have hammered the rand in this month. So we had the rand falling, and we had a surge in US tech stocks where we are heavily invested, and they combined to push the portfolio. Remember, it's been going, this portfolio has been going for nearly 3 years, to push it up by 14% in 1 month. Now, those are the kind of bonuses that you just cannot anticipate. Indeed, if you were to make 14% in a year, you can be pretty happy with that. Our portfolio, though, has been positioned for those kind of opportunities into that. I don't know why Alexa's giving us a little chirp in the background. But anyway, that's, you position the portfolio, you put your patience, you wait for the right time, and it happens. And that's what happened to us in this past month. Okay, well, let's, before we have any further ado, my colleague Stuart Lohman is in Johannesburg. Stuart?
Yes, thanks, Alec, from a sunny Joburg, as usual. There's nice summer months coming up. Always good to be here. I know you've mentioned the bumper crop we've had last month, so I'm sure it's going to be an exciting discussion with some good movers. But yeah, just from my side, I see everyone can hear us. I've got a few opinions already. Just quickly on the questions, we do like to have a conversational sort of discussion with Alex. So if you do have any questions, just send them through on the questions toolbar. It's on the right-hand control panel. And I'll sort of interject as we go and try to get it conversational, make it flow nicely. So if you can, just pop them in. As soon as anything pops into your head, just put it down and I'll pass it on to Alec. But otherwise, Alec, as always, good to be here. Another month, another share portfolio update.
Yeah. Do you want to just check that everybody can hear, Stuart?
Yes, I've checked, and I've actually got a few people who've already commented to me, so it's all good. But yeah,
all right.
Everything's ready to rock and roll.
So the hands have been raised. We can see a few of those being raised now, and there are a few comments as well. And away we go. Thank you very much for that. You don't need to raise your hands anymore. Let's sit back, relax, enjoy your lunchtime in South Africa. And we moved our clocks here in the UK on Sunday. I suppose it happens every year, but it's not something that I'm used to. And it has meant that it's a little earlier for me to get my research together for the portfolio for this month. But what a pleasure when you have such an incredible performance as we have had. Let's get straight into it. And you see, now these are interesting points. There we go. You might recall that the way that this portfolio is structured is that every month we...
Alex, just to interject, your PowerPoint hasn't not come through yet. It's just the title screen. We saw your video, but can't see the PowerPoint.
Okay, so you see these are very interesting. Technological issues that you have to get to know a little better. Stu, I hope you can see it now.
Yeah, perfect. Thanks, Alex.
Excellent. My apologies. I will one day master this technology without any glitches, but we're all human, aren't we? Let's just have a look at that then. The way the portfolio is structured is that we make changes from time to time. We invest in stocks that we believe we can hold forever. Like Warren Buffett says, if you buy a share and the stock market is closed for 5 years, you should be happy to be invested in that share. So no trading on this side. We buy stocks where the hold period is certainly notionally forever, and then we will adjust the portfolio as and when shares get overpriced or when there's a fundamental structural change at the company. Okay, so it should be pretty easy. What we do is we buy stocks over a 3-month period as well. Sometimes it works to our advantage, sometimes not. Microsoft, we bought the first tranche 2 months ago, the second tranche last month, and the final tranche now this month. As you can see, we paid up for it, call it $84 that we bought the shares for this morning. The last tranche, we bought at $73. So that gives you an indication of the way it has moved. Of course, had we bought them all of the holding 3 months ago, we'd be looking very clever. The rand was stronger and we could have got more shares. But even so, it's a good discipline that you invest in those shares, or when you invest in shares, you buy them up over a period of time. So that's to take out the impact of the exchange rate and to take out the impact of share price movements, in theory anyway. Sometimes it works, sometimes not so great. Okay, let's, so we finished our purchases of Microsoft. You can see there we now have 266 Microsoft shares. The price that we've paid on average is $77 a share, up from where we went because we paid quite a lot for the last tranche. And the price now is $84. So even so, by purchasing over those 3 month period, we've still had a nice rise and improvement of 9%. I mean, that really is just sensational. Usually when I buy into new companies, those of you who've been following this portfolio for the last 3 years will know that I tend to be a little early, a little ahead of the game, and often it takes a long time for the shares to start moving. Apple was a good example. We went down, our purchase price there, as you can see from Apple's roughly $125 a share. We were down to $90 at one stage, and it, however, has rebounded, and I'll tell you more about that later. But if you look at this portfolio, this is in US dollars. There it is. Since we launched it in December 2014, it has grown by just under 60%, which is a wonderful return. It way surpassed any of the idea that I anticipated, but primarily that was because of Amazon.com, which is up 240%. Just as a little aside, you'll see that the stocks that we have in this portfolio a lot of them are internet related and internet based. And I think the advantage that I have is that I've been in the internet field, would you believe, for 20 years. 1997, I went into the online environment when I started MoneyWeb above my garage in Parkview in Johannesburg. And clearly, as it has been the business that I've been focusing on, it's something that you watch the great players in the field, and there's a good indication of this also in our SA Champions portfolio, where Naspers accounts for 20% of that portfolio, one of the great global players. But as you can buy Naspers in South Africa, our feeling is that this is in US dollars. Let's buy stocks outside of the country. And you can then see Tencent Holdings, which is the reason for the Naspers share price boom, is part of this portfolio as well. 9% of our holding is there. And that's primarily because although we only invested, I think it was 7% of the cash into it, the share price has risen very nicely since we bought in. And that was only as recently as May 2017. So there's your portfolio. Thanks to Amazon, thanks to Alphabet, thanks also to Tesla Motors. There's some It's the only, in fact, Tesla was the only share in our portfolio that did not increase significantly in the past month. Going on to the Rand, and you can see there, our annualized return a month ago was 31%, which is extraordinary. Our annualized return now is 39%, which is, well, mind-blowing. It isn't something that you can bank and say, well, if I put $100,000 into this portfolio, we're going to grow it to 139,000 in a year. These are really extraordinary numbers. If you think long-term, the stock market will give you a return long-term of about 7% in real terms. So that is over time, and we're looking at 39%. So we could almost close the portfolio today, sit back for 10 years, and then be at least aligned with what happens in the world generally. Of course, that's not what we're going to do, but it just shows you how well we've performed. A month ago, that figure at the bottom, where you see the value in rands, the portfolio was just under 4 million rand, 3.95 million rand. In 1 month, it's gone to 4.5 million rand. So it shows you what an extraordinary month our portfolio has had, and share prices have had, again reflecting that double whammy, fall in the rand and strong improvement in the core holdings, strong rises in the core holdings of the shares that we own. Amazon and Alphabet, both exponential increases, but some pretty good increases across the board. Just an interesting point there, when you start at Vanguard, you see the profit in Vanguard has been 55% in rands. If we go back to the previous slide, the profit in dollars has been 25%. So had we just held on to, had we just put the money into US dollars, our improvement would have been, about 30%, whereas by investing in the US stock market, the gain has been 55%. So the strategy was, first and foremost, hedge yourself against the rand. Well, you can do that by putting it into money market instruments if you want. We felt that there was great value to be offered by the US stock market, so we started off with a big chunk in Vanguard, which is an index tracker for American shares, and then progressive, and then the balance, so 1/3 was in Vanguard, the balance was in share picks. And as we've got to know these markets better, we've had more confidence to go into individual stocks, and as you can see them there, they've pretty much all of them have performed. It's lovely to see a portfolio that every single one of your shares is in the black. That doesn't happen, as we well know from history, all the time. The rand's performance has also played its part. Most of the portfolio is invested in US dollars, so when you see the rand depreciating from 13 rand 60 to 14 rand 10 to the US dollar, as you can see on that little table at the top, it's clearly going to have quite an impact on the portfolio. When you then, the British pound has been a similar thing, and you can see that the big move here happened around about the time of the mini budget. There it is, mid-October, and the depreciation of the rand, it was running at around 1350 to 1360 against the US dollar, and pretty much we'd started the month and of course ended 50 cents weaker. That has had quite an impact on the portfolio's performance. Similarly, the rand against the pound, it has now got back to 1862 today, so that's almost a 50 cents depreciation there as well. Against the Hong Kong dollar, I didn't have space on this table to put it, it's also depreciated. So all around the world, the mini budget has had an impact on the value of South African assets. Stu, just want to show you the individual performances there. This is pretty obvious there. The rand profit since purchase, in other words, in the last 3 years, the rand is, we've gained 25% by just taking our rands and putting it into US dollars. But that 25%, as you can see in this graph, has been a lesser return than the stocks, the individual stocks that we bought. Alphabet and Amazon, quite obvious. Tesla's been a great winner for us. Even good old Berkshire Hathaway and Vanguard, the two bankers, the two steady ones, have done a lot better than the rand or the pure rand dollar. And Apple is coming into its own as well. Facebook we haven't held for that long, so that's a great performance, as with Tencent. Metrobank being a little bit of a sleeper, but I'm very happy to have that one in the portfolio, as we'll discuss later. Stu, shall we hit a few questions?
Yes, thanks. I think I've got two questions at the moment. From Don Krieger, he says, is it illegal to manage money on other people's behalf without an FSB license? A few of his students have started doing this, and he's raised an eyebrow or two. They are working with plus minus 300,000 Rand worth of funds from clients, he puts in the converted commas.
Is it illegal to handle? Well, it is illegal to take deposits, but I guess so you can't open a business and run a business that takes deposit if you don't have a banking license. So that's kind of where it starts. You cannot, for instance, we as BizNews couldn't put together a company and say, invest with us and then we'll invest the money for you. That would also be illegal because the FSB would have to be happy with that. But what we do is we put together a portfolio, and you can then follow that portfolio with Standard Bank or our local JSE portfolio with Easy Equities. When it gets to individuals who are taking in money and investing it on behalf of others, there are 1,000 ways around that. The most obvious way of that is Warren Buffett. What Warren Buffett did was he had the Buffett partnerships. He wasn't registered with anybody. People came to him and said, Warren, would you handle the money for me? He put it into a company which they created. The money went into that company, and that company then made investments, and they were shareholders in the company. So I wouldn't take a narrow view on it. If these individuals are handling money on behalf of friends and family, then there certainly is nothing wrong with that. If my mother-in-law were to say to me she wanted me to invest money on her behalf, I don't think there's a court in the world that would stop her from doing that. But when it comes to people soliciting funds to invest on your behalf, I think the law is pretty strong in that regard. You need some kind of a license. Hope that helps.
Thanks, Alec. Liesel just says it's quite a large valued portfolio. Should she try to replicate this with significantly less, or cherry pick a few stocks that are still value for money? What do you suggest?
Liesel, the problem with trying to cherry pick a portfolio is Murphy's Law says you're going to get it wrong, and that's just the reality of this. My recommendation would be, I'm trying to balance this portfolio as best I can. I'm also trying to ride the winners. So the big problem that one has is in the stockbroking community, they only make money from you when you trade in shares. And that's why I love having the relationship we have with Standard Bank, because Standard Bank doesn't take that approach at all. Standard Bank's approach is we want you to get rich, and then you will grow your portfolio, and you will then, in the long term, be part of our wealth creating. Everyone will win. It's almost like the Discovery approach where they call it shared value. I would say that what you should do is just try and replicate the portfolio, even if you've only got $10,000 or a lesser amount. Make the replication exactly as is, and then you've got somebody, i.e. me, who's watching the portfolio for you every month. And if things start going awry in a particular company, and it's happened, we've had 3 examples of this in the 3 years. We had Novo Nordisk, which we picked up thankfully quite early before a profit warning came out. Novo Nordisk was one of the great flyers, high flyers of the international community. In fact, the CEO was rated by Harvard Business Review as the best CEO in the world before the wheels came off there. We've had Barclays, which was a bet that we took at the wrong time, just before Brexit. We were quite excited about the new managers of Barclays and how they would fix it, or so we believed. But when some incidents happened that kind of showed you that Barclays was not everything it was telling you, or the new managers were everything it was telling you, but they were following values that were different to the ones that we believed in, we actually got out of the stock, and thank goodness we did so, because the shares have performed poorly since then. And we had a similar story with IBM, where we bought the story, we bought the turnaround, and then Warren Buffett, who had IBM as one of his top 5 holdings, turned sour on it. So we followed him. We followed him out. And that, if you like, is the value that you have by following this portfolio as a whole, because I'll keep a close eye on it for you. And then every month, as a BizNews Premium subscriber, you get to hear exactly how the portfolio has performed and keep you up to date. So I have my money invested in these stocks as well. So you know if you like value, you're running alongside. We're together, and I won't stop paying attention. That's the advantage of replicating this portfolio. When it comes to trying to cherry pick, I wouldn't know where to cherry pick today. Quite often in these webinars, we get the question to say that which of the shares would you rate as your best opportunities? And every time that I've made a suggestion, I've made a mistake. So I'm not going to do that anymore. I'm just going to carry on now. I say, stick with a full portfolio.
Thanks, Alec. Just following on from that, George wants to know, he says, is it a good time to invest in this, obviously in the portfolio, or should one wait for the rand to possibly recover a bit?
Hey, George, you know, if we were to wait for or to try and play the currency markets, we guarantee to lose money. It just is that way. My suggestion on this is that rather take 1/3 of your cash amount. So let's just say you've decided you want to put R1 million, because up to R1 million, you don't need to get exchange control or anybody's approval. Give the money to Standard Bank. They'll find a way, or they'll invest it for you in US dollars. So you take that up to R1 million. After R1 million a year, by the way, you have to start asking for permission. But you take that R1 million, and then you change that. The first month you take 300,000 of it and you convert it into dollars. The second month, another 300,000. The third month, another 300,000. Now, this is probably the most difficult decision that you're going to make, because we are social animals. We are emotional human beings. And as a consequence, we want it now. I want to buy the shares now. I want to get them today. Whereas the best way for investing is to take emotions out of it. Be rational and logical completely. And understand that if you're going to buy over 3 months, it reduces the risk of buying the currency and the stocks at the wrong time. So here's my suggestion to you, George. Put aside the amount of money that you have, be it 100,000 Rand, say. Take 1/3 today, put it into your WebTrader account. Take 1/3 today and convert that into US dollars and invest into the shares in the portfolio with those US dollars. In a month's time, the end of next month, you do the same thing for the second third, and a month's time, you do the same thing for the third, for the last third. You'll see when we do our investments, we do exactly that as well. Sometimes it works against you. We bought the Microsoft shares. Now we bought 10 less shares with the same amount of money than we bought last month. But mostly you sleep better at night. You're taking out the risk of buying or trying to time the markets, remembering that this is a portfolio you should be holding forever. Stu, happy to go?
Yeah, let's rock and roll, Alec. Thanks.
Okay. Here's the Vanguard S&P 500. This is an index tracker. This follows the performance of the US stock market, or the 500 weighted stocks, bigger stocks on the US market. S&P is a firm well known to South Africans. They rate sovereign debt, but they also rate corporate debt as well. And they have this index, which has been used now for many years, and it gives you a much better understanding than, say, the Dow, which is 30 shares equally weighted, and they are historic. These are weighted every month, every 3 months, according to their market capitalization. And as you can see, it's been a good month. There it's gone from just under 232 Rand, dollars, my apologies, to 230, nearly 236. It doesn't sound like much, but a little bump up in the Vanguard index tells you that the market overall has done better. Now try and keep this idea in your mind, because when the market does better in a month, it does give you an understanding of overall how your portfolio is structured. Did you do a lot better or not that much? Starting off with Alphabet, which is the old Google. There's the founders, Sergey Brin and Larry Page, who've made a lot of people a lot of money and done some incredible stuff for the rest of us. You can see on Alphabet, towards the end of October, the share price bumped up. So it started the month at around $970, and it got through $1,000 in early October, came back below $1,000. That was, by the way, for the very first time on the 10th of October, 11th of October, that it went above $1,000 a share, which is a benchmark for them. And then why did it surge up last Thursday? Well, that was on financial results that caught everyone by surprise in a good way. And what happened as far as Alphabet's results were concerned, remember, we have a quarterly publishing season in the United States. So every 3 months, the US companies release their financial results. And what they do is they have phone-ins that you can go and listen to the financial results yourself if you're that way inclined, and as a shareholder, you should do that. What Alphabet said in their financial results for the 3 months to the end of September was that their earnings came in at $9.50. The market had been anticipating $8.30. Well, clearly, if you're making a lot more profit than everybody thought you were going to make, it gives a surprise. And of course, the share price as a result moved up really well. The revenues year on year are up 24%. That's why I like a company like this. Exponential growth into the future, and its revenues are now looking at $28 billion a quarter, dollars that is. They're sitting on cash at $100 billion for the first time, 60% of that outside of the United States. Donald Trump has said continuously that he wants to make it attractive for American companies to bring their cash back home. If they do that, and it will require some changes to the tax laws at the moment, if US companies bring cash back home, they pay tax on it. If they do that, then Alphabet will be one of the biggest beneficiaries, bring the money back to the US and make further investments in its core business, no doubt. Some of the bull points, and those of you who've been reading the material on BizNews Premium will see that Felicity did a pretty good story just after the results, one of the advantages of having our colleague based in the US. And she gave the highlights on 3 bull factors. The one that I really liked that she spoke about was on YouTube. YouTube is, it's got 1.5 billion users. Now, just think of this for a minute. The biggest advertising medium in the world is television. Online is catching it and will surely surpass it quite soon. But television is where advertisers tend to spend most of their money. In the television of the past, you had networks. So you'd have, like the SABC in South Africa, you have in America, CBS, NBC, CBC, various networks where they have programming that people buy into. Here in the UK, the BBC is very dominant. It is, though, driven by licenses, license revenue in the main. You have Sky, who are another network, and so on. You know what I'm talking about. But what's happening now is that more and more we are consuming our video in the same way as YouTube delivers it. So YouTube, we upload videos to YouTube at any point in time. The world is now consuming its videos via a YouTube type mechanism. That's why Netflix has gone through the roof. That's why Amazon has moved into the video market. And it's something that Google has now finally gone into as well through something called YouTube Red. Go and have a look at the offering. It's not available yet, not even in the UK, but I love the kind of programming they're putting on it. It's not the drama, the stuff that makes you crazy in an already crazy world. A lot of what they've put on there are comedies. There's a lot of fun in it. It's great energy when you look at the YouTube Red channel and the original shows. Remember, these are guys with lots of money, deep pockets, and they're starting to invest in the production of video or video type content that you pay, in Netflix's case, £8 a month, and you got as much as you could eat. Now, contrast that, and of course, no advertising. You don't see any ads there. Contrast that with DSTV in South Africa, where not only do they charge you quite a lot of money, but they also pack it with advertising. clearly, if I can go and watch House of Cards on Netflix, or some of these, what are we watching at the moment? Something called Victoria, lovely show. The Crown is another example of a big investment. The Crown, I believe, was £100 million that they spent on putting that together. Now, if you've got the spending power as Netflix has got, you produce your own content. It's much more powerful and much stronger if you've got the subscriber base than to have network television. And that's why network television is dying, and dying fast around the world. It still surprises me when I look at South Africa that there are things like ANN7 and various other news-related channels that are only on satellite television. Now, why would you want to go and watch something like that when you can consume your news or comedies or entertainment, etc., as and when you want it? So that's what's happening in the world. If you, for instance, want to watch the great Trevor Noah, who has got his show at a particular time on Comedy Central, you can also pick it up in South Africa when you're awake. You don't have to wait until such time as Comedy Central is broadcasting broadcasting the first show of Trevor Noah. So you'd pick it up at a time that it suits you and is convenient to you, and you won't be sitting there watching a network channel that's got to fill the channel 24/7. How about giving you some insight into that? So here we've got YouTube Red, which is will be going head to head with Amazon's fantastic offering, and also with Netflix's offering. And these are like super studio production houses, or production houses, Hollywood production houses on steroids. This is the future, and this is something where Alphabet has another big upside, and people are starting to understand. Imagine you start off with 1.5 billion viewers. How can you go wrong? It's incredible. Anyway, Alphabet's results, excellent. The whole YouTube story really getting exciting. The click-through rates surging. They've moved from desktop into the mobile advertising space. They're still doing desktop, but mobile advertising, internet advertising is an area they've successfully moved into. The click-through rates have been going through the roof after being declining for many, many years. This is a company on a roll. It did give us an opportunity to buy in cheaper. Those of you who hadn't bought into Alphabet in the past, after the EU attacked Alphabet or Google, its major subsidiary, on a competitions or an antitrust issue. But that's now way forgotten because it's a small, tiny, it's a minuscule thing in the grand scheme of things for Alphabet. And there you can see the share price and the market capitalization, $700 billion, and through $1,000 a share for the first time. Boy, are we glad we got these shares.
Thanks, Eric. Just on Alphabet, there's a question from Peter Jones who says, can you buy different class, which is cheaper, different class of share? Obviously, he's looking at the $1,000 price tag, yes. I think.
Yes, Peter, there are two classes of share, and this is something that's been repeated with Facebook as well. Although they don't list two classes on Facebook. In fact, it's repeated with Shoprite. If you have a look at, just to put it into context, when Shoprite started off, they issued preference shares, and Christo Wiese owned enough preference shares with super votes to control the company with less than 50% of the capital. And it's a similar thing that's happened here with Alphabet. When Sergey Brin and Larry Page listed the share together with their chairman, Eric Schmidt, they issued a new class of share, the C-class shares, which have got more votes, many more votes than the A-class shares. So, this is the, my apologies, we're showing the A-class shares, which has got more votes than the GOOG, G-O-O-G. I've put up the wrong graph here because the one we've got in our portfolio is G-O-O, let's just go there. We've got GOOG, G-O-O-G, and if you see there, the price on GOOG, which is the low voting shares, is $1,017. While I was putting this together, I made a mistake and put in the Class A share at 1033. So, but the performance of the share price is very similar. We don't own the Class A, we own the Class C shares. You can buy one or the other. if you're buying Class A, it'll have a small premium over the Class C. In other words, the high voting shares will have a premium over the lower voting shares, because if somebody ever wanted to come and acquire or buy out Alphabet, they would need to all they need to do is make an offer or acquire the A class shares, and then they would get control. In other words, they buy from Sergey, from Larry, and from Eric. But at $700 billion, it's going to be quite a long time before anybody has got that kind of cash. And this is, I think, at the moment, the second highest market cap stock in the world. So we're quite happy having the C class shares, the lower voting shares. But if you want to believe that at some point in time there'll be a change in control, then you can pay the little bit of premium.
Thanks, Alex. Just a question that's popped up with a few people. Just how do you feel about Euro stocks, with particular reference to the Euro Stock 600?
You know, the reason why we went into the S&P 500 index was because I have a very deep belief that the Americans are business scientists, and elsewhere in the world we are social scientists. What does that mean? That means that when you're structuring a business in the United States, then you actually look at the profitability first and the sustainability perhaps of your social license second. Whereas if you're in Europe, it's the sustainability of your social license first. Now that means that you get, I'm not going to give you any philosophical view on that, but it means that you're likely to have a better financial performance from an American company than from a European company, all other things being equal. Europe has got some endemic issues that it has to deal with. Some very, very serious social issues, uncompetitiveness. Remember, Europe has got about 1/10 of the people on Earth, but they own about 1/4 of the global wealth. However, they work much, much less than people who earn much smaller percentages of global wealth. Now, it's fine. The Americans have got 5% of people on Earth with 25% of the global wealth. And so they've got to keep, if you like, running fast. They've got to keep going ahead to just maintain that rather than to come back to the normality, which would be 5% of people should have 5% of global wealth. They've got a really good system, and they're really, really good business people. The Europeans have got not such a good system of distributing goods and services, and they're not such good business people as the Americans. You know, the Europeans still they like their holidays, and they have laws that say you can't work more than, say, 40 hours a week. Where the US, they don't take much holiday, and they certainly don't have a 40-hour-a-week maximum working time. The Chinese, on the other hand, will work for less money, and as will the Indians, for less money and for less holidays, because they are hungrier than the Americans even. So if you put all of that together, you're looking at Europe, you've got to shake your head and think, would I be investing in that system as a whole? And that's what you're doing when you're buying the Euro stocks. It's not to say there aren't some brilliant European companies, and some of the companies are absolutely fantastic investments. I just haven't had one that's jumped out at me and has said that this company is good, apart from Metrobank here in the UK. This company is better than, say, an Alphabet, an Amazon, a Microsoft, a Tencent from China, and so on. I hope that helps.
Thanks, Alex.
Moving on to Amazon, this is our star performer. That's Jeff Bezos. He is now getting the recognition he richly deserves. He could seriously disrupt just about anything. One of the few undisruptible areas is big goods, and I'll give you a personal example. In August this year, I ordered through Amazon 2 bookcases. I love reading, and I love being surrounded by books. I think, let's just have a look at this. I'll show you what I'm talking about here. There you can see, that's a little bookcase there. I've got one on the other wall, and that's a little bookcase there. Okay. And one on the other wall, one in Jeanette's office. I just love being surrounded by books. So what happened was, in August this year, I went onto Amazon, looked for a bookcase, and found a smashing for that space behind me. Two absolutely perfect. They fitted nice. The measurements were nice. I paid the rather extortionate price for them, and waited, and they still haven't been delivered. So Amazon is not so good when it comes to big items. These are big bookcases. These are bookcases that'll be kind of, I think, 2 meters high. It's the same thing with bedding or beds. The same thing with appliances. Amazon's not great at that. But what it's great, because its model is on distribution, it's warehousing and distribution. And you know that when you've got a huge item where the margin's not so good, or certainly isn't as good as smaller items, then it's not something that a business scientist like Jeff Bezos would be going in for. I've learned my lesson. I'm still waiting, by the way, for these bookcases. I don't know if they're ever going to get delivered, but hopefully somebody somewhere will answer my emails. But that shows you that a company like Steinhoff, for instance, in South Africa, is really, really well positioned, and they're not Amazon vulnerable because they've gone for these big. They're in the delivery system of beds and furniture and the stuff Amazon's not that good at. But where Amazon does focus its attention, my goodness, you got to start worrying. They did it recently when they bought Whole Foods, and that acquisition sent a shockwave through the whole food distribution industry or the food retailing industry. They've now just done it the other day with the information coming out that Amazon has acquired wholesaler licenses in pharmaceuticals in 13 US states. The consequence of that was drug distributors in the US had a massive sell-off. So Amazon moving into the market, get out of the shares that are going to be competing with them. Amazon, of course, had no comment about its move into any other area, but it gives you an understanding that it can look at things. It's got this thing called Amazon Prime, which we're members of. We pay, I think it's 70 or call it 80 pounds a year. It gives you lots of free movies, free music, free delivery. It's a wonderful system if you use it, and if you don't use it, it's pretty wonderful anyway, because you could use it at some point in time. But it's great for shareholders because Amazon have now got these millions and millions of people who signed up to Prime who just give it annuity revenue. They also launched something called Business Prime Shipping, where Amazon is now moving into delivery. They launched this a couple of years ago, but they haven't really focused on it yet. Moving into delivery to factories, hospitals, offices. So now you see what we're talking about with pharma products. If you're delivering to hospitals and you actually are a wholesaler of drugs or pharmaceuticals, it's an opportunity for you. And with the margins and the distribution base that Amazon has got, it can wipe out competitors. They call it the Amazon effect. In fact, who's they? Warren Buffett and Charlie Munger. If you want to go onto Biz News and just put in Amazon, Bezos, Munger, Buffett, you'll into the search, you'll quickly come up with the part from the Berkshire Hathaway AGM where they sang Bezos's praises. The reason why Amazon's share price surged in this past month, though, was just like with Alphabet. They came out with financial results on Thursday, and they were expected to show a profit of 3 cents a share. Bezos doesn't really care for profits. He's reinvested over the last 30 years, or 20 years rather. He's been reinvesting continuously. Every bit of profit that is made, they put it back into the business, and that's what shareholders expect. But in the third quarter, they showed a profit of 52 cents, remember, against an expectation of 3 cents. And the market just loved it. This is a company that, well, its share price in the past month's gone from $950 to $1,110, $60 improvement. And of course, we banked that all the way to the bank. Today, Amazon generates 44 cents of each dollar spent online online e-commerce in the United States. 44 cents of that goes to Amazon, and that is just growing. It was at 38 cents a year ago. I haven't got the UK figures, but I can assure you it's also moving in that direction. This is a company that is only now hitting its straps, and one doesn't know where the Amazon effect will end. All I can say is I'm very glad we got it in the portfolio, and I'd be even happy today to be buying them.
Thanks, Alex. Just on Amazon, Alec, Harun and Thea have got two questions. Harun wants to know why analysts forecast such a low EPS. You know, he wants to know why they got it so wrong, I think. And Theo just asked about Amazon's PE, which I'm sure is not something we take into account with an exponential company, but he just asked what's the PE.
They're two very good questions. The analysts, Bezos doesn't actually give a hoot what the analysts think. He doesn't give a hoot about Wall Street. He was punished by them in the early days, a bit like Elon Musk, by the way. They do not pay attention to the quarter-writers' obsessions of Wall Street. Excuse me. Wall Street is telling these guys how to run their businesses, and people like Musk and Bezos say, don't come out of university, get yourself a CFA and say you can teach me how to run my business. Stick to what you know, which is crunching numbers. You can either decide you want to be part of it or not. I'm going to run the business the way I like. If I can tell you in my career for 37 years in financial journalism, the number of company executives who've been able, had the guts to say that, have been relatively few, but hugely successful. The ones who run their businesses, not for the market, but because they understand their businesses and they run it for the long term. On the other hand, I can also give you some very good examples, if I were to apply my mind to it, of companies that were run by chief executives who ran it for the market. And unfortunately, the differential between the two is usually professional managers who run it for the market and owners or entrepreneurs who started the business who run it for the long term. And Amazon was started by Bezos, he runs it. Google, now Alphabet, was started by Larry and Sergey. They run it for their own business. Elon Musk started Tesla. He runs it because he understands it's his own business. He doesn't have to kowtow to the market. And it's a massive differentiator when you think about buying stock in a company or buying co-ownership in a company. Beware when you invest with professional managers. Beware, because often their intentions will be associated by what happens on Wall Street or how Wall Street is determining their stock price, because these guys are incentivized through share options and they retire. Buffett is 86, he still hasn't retired. So you'll see in this portfolio, we've got a predominance of entrepreneurs, the same thing with the South African portfolio. So the analysts will come out with an estimate for Amazon of 3 cents, and Bezos will tease them and bring it out this month at 52. If he wanted to, he could do it out at $5. Amazon can switch on and off the profit tap as it likes. The reason that the profit tap is not wound up to full is because he still thinks he's got huge growth to go. So he reinvests. Bezos keeps reinvesting in his business. Extraordinary the business. Rather be his partner. Rather go along with it. Is there still scope for Amazon into the future? Absolutely. Exponential companies are those that grow at this kind of a growth rate. Their sales at Amazon are 34%. Now, all you have to do is sit back. Well, look at our portfolio, where the portfolio has grown at 39% over 3 years, annualized. We've gone from 2 million Rand to 4.5 million Rand. That's extraordinary. And the same thing, when you're growing at that kind of rate, how do you work out a price? How do you work out a PE? PEs do not apply in companies that are growing at an exponential rate. They don't matter. PEs are price, which is the share price. We see there, $1,100, to earnings. But Bezos says, I don't want to give you earnings because I'm reinvesting everything into the business. So where does the PE come from? It's a nonsense number in Amazon's case. PEs matter when you get to a company like this one, Berkshire Hathaway, where its investments are in companies that Warren Buffett sees will be able to generate profits into the future. It doesn't work with an exponential company like this one, Apple Inc., where you can see that share price. This is the biggest or the most valuable company on earth, 860 billion market capitalization. And why has Apple's shares run so hard? They haven't come out with their financial results yet. Those are going to be coming out on Friday this week. But people are terribly excited about Apple because of its new iPhone. Now remember, Apple generates over half of its revenues from sales of iPhones, and the iPhone 8 was disappointing. And as a consequence, in the anticipation towards the launch of iPhone 8, the the share price went up and then came back a little bit. This push has been through the iPhone X. 10 years since Steve Jobs launched the first or brought the first iPhone and transformed our society in 2007. iPhone X launch is this week on Friday. It's coming out, and the pre-orders for the iPhone X have been, to quote the Apple spokesman, off the charts. Not surprisingly, people were holding back. The analysts, again, Wall Street, getting all excited. Oh, here comes a new model. It's going to be much better than the 7. People are going to buy it. Apple buyers or Apple fans like myself are saying, hang on, if I'm going to get a new iPhone, I know the X is coming out in September, in early November. I'll rather wait for the X. Why should I buy the 8 when it's going to be obsolete in just a few weeks? The big thing that's surprising everybody is that the pricing of the X is $999, but pre-orders for it say that it's going to take something like 4 months before equilibrium is reached. So you're going to have to put your name on a waiting list, and you could wait for 4 months until you get your iPhone X. That is a successful product, and that's the product that we're seeing. Also, the market's very clever. The suppliers to Apple, AMS was up 29%, ST Micro up 20%, those share price in a week because of the anticipation of what's happening with X. Facebook has also had a phenomenal week. It enjoyed the improvement. Its results come out on Wednesday. It's gone up strongly. In fact, the share price in the month, $167 last month, $179, up $12 in the month. And as you can see, it moved very strongly. The bullish sentiment there came because of the financial results from Alphabet, which is in the same field, advertising field that Facebook is in. So Facebook moving up in sympathy to, as you can see, an all-time record. Tesla, I just need to spend a little bit of time on this one before we finish off the webinar for today. Tesla's share price is the only one in our portfolio that's gone down in the last month. It's gone from 340 to 320, and it actually got to a point of 360 at some point in the month. Why? Well, its numbers are coming out this week as well, and the concern is that Elon Musk's anticipation for the Model 3 has been a little overblown. You either love Tesla or you hate it. I love it. I love Elon. I think he's done us proud. We're up 60-odd% in the portfolio on the investment here, so there's plenty of scope for the share price to correct before we start getting worried. And I just wouldn't worry, because here is a man. He's a genius. He's South African as well, which of course gives us quite a lot of, if you like, sentimental support apart from anything else on what Tesla is doing. And they are transforming the world of motor vehicles. They've been the flagship in the same way that Steve Jobs' iPhone transformed mobile telephony. Elon Musk's electric car, Teslas, are transforming the whole motor vehicle sector, killing the internal combustion engine. So put these away. 5 years' time, you can almost be certain that they're going to be worth a lot more. Metro Bank, there's a new picture for you. I met the chairman, Vernon Hill. That's his book called Fans. I wrote had a fantastic interview with him. So go on to Premium and go and read that interview. You just got to be impressed by this man. He's 72. He's running his second bank. He started Commerce Bank when he was 26. He got a license, built it into an $8.5 billion business, and now he's doing the same thing with Metro Bank in the UK. The results came out. I just want to give you these numbers because it emphasizes what an extraordinary growth story this is. The company's been going 7 years. They've had their fifth quarter of profit. So it's a bank, the first high street bank in the UK in 140 years. They've been going now since 2010. They've had the latest profits were £7.2 million, up 77% on the same period a year ago. The year to date, they are going to show a profit. They forecast they'll show a profit this year. They're looking at the moment at somewhere near 20 million, so call it 15 million pounds. Last year, there was a loss of 12.5 million pounds. So it's almost like they're hitting that hockey stick, you know, with a hockey stick where you lose money and then, boom, you move into the green. That seems to be happening here. Deposits are the big thing that they focus on in this company, up 47% in the past year, and they pay 50 basis points, 0.5%, for those deposits, and that's down from 53 basis points. The lending was up even stronger than that, loans up 66%. I'm impressed by this business. It's like a Capitec, and I did a little comparison. When Capitec was 7 years old, it was also listed on the then case in the Johannesburg Stock Exchange. The share price was 30 Rand a share. Capitec, you've got to pay more than 900 Rand today, 10 years later. Metro's share price is £35 a share. Who's to say in 10 years' time it's not going to be £900? Well, certainly Vernon Hill said to me, we're a 3 billion market cap business. He would anticipate that they'd get to 40 to 50 billion, given the estimations of the market shares that they're looking at. It's the UK's Capitec, and we've seen the movie. So you don't really have to guess too much for this company. Share price, though, a little bit up this month. Not worrying, because it gives you opportunity to buy more. In fact, I bought 50 more shares in the last month in Metro Bank. Very happy with it. And finally, Tencent Holdings. There's Pony Ma, the chief executive. The share price of Tencent had a bit of a bouncy ride in the past month, but this is one that we as South Africans know quite well, given Naspers' investment there. So not a whole lot to report until we see their results. And finally, Microsoft. Wow, hasn't this been a winner for the portfolio? We've only bought into it 3 months ago. We've just finished our final bit of purchasing, and it's already showing us a return of almost double-digit figures. Reason, Microsoft's results came out far better than anticipated. Remember, this is a business that's been around a long time. It's got a legacy business, but they moved into cloud computing at the right time. The cloud computing area, which is now, it's about 5 billion revenues of 25 billion for the quarter, and it makes a margin of 57%. Imagine having a business that generates 57% margin. If they were to just strip the cloud computing basis out, it'd be interesting to see what that would be valued at. Interestingly enough, the growth year on year is 90%, 90%. And who are the two dominant players in cloud computing? Microsoft and Amazon. Those are the two big players in this field, and terribly exciting to be invested in both of those companies. There's the portfolio in Rand to close off with. Please don't anticipate that 39% is going to be a standard procedure for us indefinitely, but it's nice while we can look at that and see big ones. Stu, shall we finish off with a couple of questions?
Yes, thanks, Alec. A question, I think it's one of Thea from Claire. She says that the market seems scarily high. Are you not worried, or do you see a crash in the near future? I mean,
you know, it's a very interesting question, that, because when you have been around for as long as I've been around, that sounds terrible, but okay, I'll just show you. I don't have too many wrinkles and things, but I started in journalism as a 20-year-old in 1980, and at that time the gold market was flying. So when the gold price, it was an incredible start to my career, because every day you'd see the gold price going by $20, $30, $40. Every time there was a gold fix, the whole world in South Africa, not the whole world, but in South Africa, we would stop, because back then gold was by far the biggest export earner for the country. We've seen the deterioration of the mining industry, which is a very sad point. But I saw the gold market, and I saw the boom and the bust, and I saw how people operated then. Then in 1987, we had the first stock market boom bust that I've witnessed. Again, I saw the same thing in 97, where just before the emerging market crash, South Africans went moggy. We also saw the dot-com bubble in the United States, which fell off a cliff in 2000. So these, and then of course the 2008 global financial crisis, where everything fell in a heap again. And the point I'm trying to make is that there's a certain psychology, there's a certain mentality that one sees when markets get overheated. I'm a great believer in Alexander Dow's Dow theory, which he wrote about in the 1800s. He was a Scots orphan who went to the United States and became one of the great financial journalists of all times. He started the Wall Street Journal, and the Dow is named after him, the Dow Index, after Alexander Dow, who started that one. And what he showed in the Dow theory was that the markets work in certain big cycles, and the cycles are based on behavioral economics, or the behavior, the way that crowds behave. And I'm not seeing the hysteria about shares that I saw in 87, 97, 2000, and in 2008. Nowhere near it. And as a consequence, a big crash, it could happen. Anything can happen. Who knows? I mean, it could be a nuclear bomb exploding. But from what we do understand, right now, the market is not at a space where it's hugely overvalued. One final point on this, which is really important. In South Africa, we've got to understand, because we have mining shares and we have other shares on the market. And this is in years gone by. Mining was by far the dominant sector of the economy. And the mining shares were the biggest sector of the JSE. So they would operate in one way. They would have their own little mission, if you like, whereas the rest of the shares in the JSE could be operating in a completely different way. We're seeing this in the United States today, where you have these exponential companies, the ones we have in our portfolio: Alphabet, Amazon, Apple, Facebook, Microsoft, Netflix we don't have in the portfolio, but those are the kind of companies that they're exponential businesses, they're growing exponentially, they are thriving. And then you have most of industrial America or middle America, which is struggling. And when you look then at, because there's the fourth industrial revolution, things are changing, dramatic changes. Banks, think of how banks have got to now deal not with a Metro Bank in the UK and a Capitec in South Africa, but with challenger banks, banks that in South Africa, there's a new one called Time that's coming, backed by Commonwealth Bank of Australia, who is a digital bank. They're Amazonizing, if you like, the banking sector. So what would happen to the bank share prices? Well, they're not going to be surging in that kind of environment when they have these huge competitors coming along. Our experience as South Africans really positions us to understand this world very well, because we can see that you can have one group that are on their own hectic mission, as the exponential companies are, and the rest of the marketplace, not sure exactly what their future is going to be like. So it's a very interesting time to be invested in shares and to be picking shares. One final point there, when you have a look at Vanguard, the profit in Rand is 55%, that's pretty good, but in US dollars, it's only 25 in 3 years. So the overall market in the US has not exactly been surging ahead in the same way as the exponential companies are. I'm not worried.
Sorry, Alec, there's a nice question to finish off here from Steve Backus. He says, where to now, Alec? We've got $45 in cash. What's the next move?
Well, the next move is that we monitor our holdings very carefully. I am looking at a new purchase, as I'm doing all the time. I'm looking for something that will outperform. It took me a heck of a long time to finally invest in Microsoft. Those of you who've been, and Facebook. I was thinking of Facebook right in the early days in 2014, and it just looked too expensive. And that was a big lesson. Apple, again, we bought in twice, actually. We bought in two tranches, the two different periods, and maybe we should have bought in thrice and bought even more when it got down to $90. But right now, we have got Vanguard and Berkshire, our two bankers, who are sitting on 14%, call it 15% of the portfolio, call it about an eighth of the portfolio, that we can, I'll be very comfortable to trade that in, if you like, on two stock picks. So that's where to from here. Right now, the important thing is be patient, ride your winners, and don't panic. When you look at, we had panicked at any time in the last 3 years on Amazon and said, let's take profits, or Alphabet, we would be looking very sick today. It's a similar thing in the South African market when people say, oh, we've got to take our profits on Naspers because it has an even more impressive run than Amazon has had. my view on investing is when you get lucky enough to find a winner like this, don't be dumb. Stick with it. The reason you bought the share in the first place was you wanted to hold it forever. So we're going to be holding it forever. But where to from here? If we see the appeal of another stock and as you'll know, those of you who've been following the portfolio for a long time, I'm a pretty slow learner, and I really take my time in doing the analysis on the shares because they must be owned forever. Lots of things, the planets have got to align, and in some cases they take a little while to do that. But we've got capacity. We've got the capacity of putting that 15% in. And in essence, what we can do is, once that's done, is if you were to find a really good opportunity, there's nothing wrong with sizing that up against something else in the portfolio where the opportunity is perhaps not as good into the future, and then switching your portfolio. I've done that in the SA Champions, for instance, where we got out of Blue Label and we went into Glencore, and that's been an inspired move. And then we got out of Wilson Bailey Homes and upped our holding of Naspers. Both of those have worked out for us, but both of those took quite a lot of research and analysis beforehand.
Sure, thanks, Alec.
Well, that's our portfolio for today. I hope you've enjoyed the presentation. It's been, as always, a real privilege and a pleasure to be with you. Coming to you from London. There we go. Can have a look at that's a better framing of the picture. And I look forward to being back in your company again next month. For all the premium subscribers we're giving, I hope you're enjoying the fact that we are now giving you, we're working hard on that, on our model. Felicity Duncan, those of you who remember her from the days when we worked together at MoneyWeb, is now our editor. She's doing a cracking job. We're bringing lots of new content every day. And in fact, we're taking quite a bit of stuff now that we would have just put into the free to est site and adding value by doing it on the premium site. So we're very excited about the future of premium, and thank you very much for your support, and be sure that we'll continue to work and to serve global South Africans wherever they live in the world, because we have a mission to promote democracy in South Africa by supporting free enterprise and attacking corruption. But you knew that already, didn't you? It's nice to make good investments along the way. Thanks for being with us, and I look forward to being back with you again next month. Stuart?
Thanks, Alec. And yes, we've got the SA Champions portfolio update on the 15th of November, which you'll find at the bottom of the premium newsletter, which comes out daily from tomorrow.